Let's talk about money. You work hard for it. You earn it. You spend it. But what if your money could start working for you? Imagine your dollars going out and bringing back more dollars, all while you're sleeping or watching Netflix. This isn't some get-rich-quick scheme. It's a real, powerful concept that has built incredible wealth for people over time. It's the secret sauce that separates just saving money from actually growing it into something substantial. The goal is to put your money into a position where it can multiply, creating a snowball effect that gets bigger and bigger as it rolls downhill. This is how you build a solid financial future. So how do you put your money to work? One of the best ways is through investing. Now, I know what you might be thinking. Investing sounds complicated, risky, and maybe even a little scary. People picture complicated charts and fast-talking experts on TV, but it doesn't have to be that way at all. In fact, one of the most popular and straightforward ways for beginners to get started is with something called a mutual fund. Think of it as a big basket of investments. Instead of you having to pick individual stocks or bonds, a professional manager does it for you, spreading your money across many different companies. This approach is fantastic for a few reasons. First, it gives you instant diversification. That's a fancy word that just means you're not putting all your eggs in one basket. If one company in the fund doesn't do well, it's balanced out by the many others that are doing great. This lowers your risk significantly compared to buying just one or two stocks. It's like buying a pre-made party platter instead of having to go to 10 different stores to buy all the individual snacks yourself. It's convenient, it's balanced, and it's managed by someone who knows what they're doing. The real magic happens when you combine a smart investment vehicle like a mutual fund with the most powerful force in finance, compound interest. This is where your money truly starts to work for you, and then the money it earns starts working for you too. It's a cycle of growth that can turn a small, consistent investment into a life-changing amount of money over the long term. Forget about timing the market or finding the next big thing. The most reliable path to wealth is simply letting your money grow on itself year after year. It's simple, it's effective, and it's available to absolutely everyone. To understand how your money grows, we need to talk about interest. Let's start with the basics. Simple interest. It's exactly what it sounds like. Simple. Imagine you have $1,000 and you put it into an account that pays 10% simple interest per year. After the first year, you earn $100 in interest, which is 10% of $1,000. The next year, you earn another $100. The year after that, another $100. You see the pattern? With simple interest, you only ever earn interest on your original investment, that initial $1,000. It's predictable and steady, but it's not very exciting. Your earnings are always the same, year after year. Now let's look at its much cooler, more powerful cousin compound interest. This is where things get really interesting. Let's use that same $1,000 with the same 10% interest rate. After the first year, you earn $100, just like before. Your total is now $1,100. But here's the game changer. In the second year, you don't earn interest on your original $1,000. Instead, you earn interest on the new total of $1,100. So 10% of $1,100 is $110. Now your total is $1,210. In the third year, you earn 10% on $1,210, which is $121. Your earnings are growing each year because you're earning interest on your interest. This difference might seem small at first. Who cares about an extra $10 or $21? But over time, the gap between simple and compound interest becomes a massive canyon. Think of it like a snowball. With simple interest, you just keep adding a little bit of snow to the top. With compound interest, you're rolling that snowball down a hill. As it rolls, it picks up more snow, gets bigger, and starts rolling faster, picking up even more snow. The growth isn't just adding, it's multiplying. This is why Albert Einstein supposedly called compound interest the eighth wonder of the world. So when you see those two options side by side, the choice is obvious. You want your money to compound. You want your earnings to start generating their own earnings. This is the engine of wealth creation. Simple interest will give you a little boost, but compound interest is what will launch you into a different financial league. It's the difference between walking up a flight of stairs and taking an escalator that's speeding up the higher you go. You're not just moving forward, your progress is accelerating every single step of the way. So we know mutual funds are baskets of investments, and we know compound interest is financial magic. How do they work together? It's a beautiful partnership. When you invest in a mutual fund, you own a small piece of all the assets inside it, stocks, bonds, or other securities. These assets are chosen by a fund manager to generate returns. These returns can come in two main forms: dividends from stocks, which is a share of a company's profits, and capital gains, which is when the fund sells an asset for more than it paid. This is the interest your mutual fund earns for you. Here's where the compounding kicks in. Most mutual funds give you the option to automatically reinvest your earnings. This is a crucial step. Instead of taking the dividends or capital gains as cash, you use them to buy more shares of the mutual fund. Let's say you invested $10,000 in a fund. After a year, it generated a 10% return, giving you $1,000 in earnings. If you automatically reinvest, that $1,000 is used to buy more shares. Now, you have $11,000 working for you in the fund, not just the original $10,000. You own more shares than you started with, without spending an extra penny from your pocket. The next year, your now larger investment of $11,000 goes to work. If the fund earns another 10%, your return isn't on the initial $10,000, it's on the full $11,000. That means you earn $1,100. You reinvest that, and now you have $12,100 invested. You can see the snowball effect in action. Every time your fund earns money, your ownership stake gets bigger. A bigger stake means you're entitled to a larger slice of the future profits, which then get reinvested to make your stake even bigger. It's a powerful, self-fueling cycle of growth that happens quietly in the background. This process makes building wealth incredibly passive and efficient. You don't have to log in every day or make active decisions. By simply setting up automatic reinvestment, you are putting the law of compounding on your side. The fund does its thing, the earnings are generated, and they automatically go back to work for you, increasing your potential for future earnings. This is how you leverage the market's long-term growth. You're not just investing, you're creating a system where your investment continuously feeds itself, growing larger and more powerful over time. If compound interest is the engine, then time is the fuel. The single most important factor in maximizing the power of compounding is starting as early as possible. Let's look at two friends, Anna and Ben. Anna starts investing $200 a month at age 25. She does this for just 10 years and then stops, never adding another dollar. By age 35, she has invested a total of $24,000. Her money just sits there and grows. Ben, on the other hand, waits until he's 35 to start. He invests the same $200 a month, but he does it all the way until he's 65, for a full 30 years. He invests a total of $72,000. Now, who do you think has more money at age 65, assuming an average 8% annual return? It's Anna, by a long shot. Even though she invested only 1/3 of the money Ben did, her early start gave her portfolio an extra 10 years to compound. Her initial investments had decades to grow on themselves, creating a much larger snowball. Ben tried to catch up by investing more money for a longer period, but he could never overcome the head start that time gave Anna. This isn't a trick question. It's a powerful demonstration of how important your investing timeline is. The years you skip are your most valuable. This is why I always say that the best time to start investing was yesterday. The second best time is today. It doesn't matter if you can only start with a small amount like $25 or $50 a month. The habit and the timeline are far more important than the initial amount. Getting your money into the market and letting it begin the compounding process is the first and most critical step. Every day you wait is a day of potential compounding growth that you can never get back. Don't fall into the trap of thinking you need a lot of money to start. You need a lot of time. Ultimately, building wealth through investing in mutual funds is a marathon, not a sprint. It's about patience, consistency, and letting the incredible power of compound interest do its job over decades. By starting early, choosing a diversified vehicle like a mutual fund, and automatically reinvesting your earnings, you are setting up a system for financial success. Don't be intimidated by the process. Embrace the simplicity of it. Let your money work for you. Let time be your greatest ally, and watch as small, steady efforts compound into a future of financial freedom. The journey starts now.